Thank you for the invitation to be part of your conference today. I'm very sorry I'm not with you in Brisbane, but I'm required to appear before Senate estimates this afternoon in Canberra, and the logistics made it too hard to be in both places. I was going to speak this morning about the Australian economy and a little bit about energy efficiency, which is something close to my heart. Australia has faced many challenges and shown itself to be very adaptive through several decades of significant change in the global and domestic economies. As the contribution from mining investment falls back and fiscal constraint continues, Australia's economic growth at around 2.5% has slipped below our long-term trend rate. Our economic growth and low inflation has been sustained over a 21-year period without a major downturn. Australia's growth has, however, been far from evenly spread. As those in this room will be well aware, while some industries have boomed, others have experienced very adverse circumstances. This economic performance is certainly less patchy and volatile than that of many other countries. Over the 5 years since the depths of the global financial crisis, the Australian economy has expanded 13%. This compares to 3% in the US, and for Japan, Europe and the UK area, growth has been negative. The economic activity in Australia has supported our growth. Over this same 5-year period, China's GDP has risen by 50%, Korea's in line with Australia by 13%, and Singapore by 18%. We are a lucky country, but these economic outcomes do not just happen. They are a consequence of the responsiveness of public policy, businesses, households, and the workforce to changes which the global and domestic economies experience. World economic conditions continue to improve. China's growth is heading back to the authorities' target of 7.5%. Japan's growth has increased in response to their policy stimulus, and growth in the US and Europe is strengthening. Europe has just recorded slightly positive growth, although again not evenly spread, with Germany growing and the rest of Europe slow. This recovery is likely to continue as inflation stays low and monetary policies remain accommodative. Growth in Australia's major trading partners in the September quarter has moved back up to its average of the past decade. Individual companies and their treasurers are responding to the challenges of a strong and volatile Australian dollar, and with a change in government, the discontinuity of our domestic policies. It is worth considering Australia's economic performance over the last 2 decades and the changing forces at work. It is encouraging to our capacity to adjust to future challenges. There is always uncertainty about where future growth will come from. We can, however, gain comfort from Australia's sound starting point and our demonstrated adaptiveness to very challenging global and domestic dynamics. The last 2 decades has seen significant global disruption and a shift in the source of growth, of world growth, away from the developed world in favour of the developing countries. Australia too has undergone considerable adjustment. In light of the extraordinary global developments, this adjustment, though harder for some than others, has proceeded pretty well. While the drivers of Australia's growth have shifted from household spending to public spending in the depths of the GFC, then to mining investment, we have maintained our trend growth and relatively low unemployment throughout. Australia is not just a lucky country. We have sound foundations and a demonstrated capacity to adjust to changing circumstances. The shift in the share of economic activity to the developing countries, not just in Asia but more broadly, has accelerated since the global financial crisis in 2008. As challenges to the banking system and fiscal imbalances in Europe, the UK and the US in particular are slowing the recovery in those economies. The share of emerging economies in global output has increased from 30% 20 years ago to over 50% today. In the last 2 years alone, 75% of global growth has come from the emerging economies. A 10% share of world GDP has shifted to China, principally out of Japan as their economy has shrunk. Brazil now has a bigger economy than the UK. This change in sources of growth favours Australia as our trading partners continue to grow faster than the rest of the world. Domestically too, the contributors to our GDP growth have changed dramatically. In the decade to 2005, household demand was the prominent driver of growth. Household consumption grew faster than income. Buoyed by rising home and equity prices, borrowings increased and the household savings ratio fell to zero, even negative. In 2004, housing credit was growing at an unsustainable 20% per annum. Since 2008, household consumption has been growing more slowly than income, and the savings ratio is now back to 10%. Through the GFC, as consumers slowed their spending, Australia was buffered by the government stimulus package and a 4.25% drop in the Reserve Bank cash rate in 1 year. While unemployment rose 2%, business and employees responded by cutting working hours rather than layoffs. This approach provided a substantial buffer. While world GDP declined, Australia's trend growth was maintained. As commodity prices bounced back from late 2009, Australia began undertaking the biggest resource investment upsurge in our history. The majority of this investment was financed out of cash flow rather than borrowings. In the last 3 years, mining investment, which makes up 42% of private capital expenditure, increased by 88%. Non-mining investment fell by 4.1%. We are now looking for a handover to the next growth driver as mining investment falls back. Mining investment will not stop overnight. It is expected to plateau and ease back. As current projects are completed, the output produced is boosting our exports. Exports of LNG could rise 400% from 2014 to 2018. The basket of Australia's commodities rose 370% above its level in 2000. It has fallen 27%, so it is now only 240% higher than 13 years ago, a pretty high level. How and when will non-mining kick in? There are some early signs of a pickup in this sector. Availability and the price of labour for housing and building construction should improve as the mining sector slows. Australia is at a good starting position to generate growth out of our traditional drivers: housing investment, household consumption, and non-mining investment. Each of these areas, at least, is well placed to expand once they have the confidence to do so. Monetary policy settings are currently primed to lift the non-mining sectors of the economy. The Reserve Bank has delivered 225 basis point cuts in the past 2 years, which have largely been passed through into lower borrowing costs for businesses and households. With their high level of savings, households are in a healthy shape. We should not expect a return to the pre-GFC debt financing of consumption, but consumers are likely to lift their spending restrictions. Household spending can be expected to grow with income and a stronger housing market. National housing prices are up 10% from their trough in May 2012, and finance approvals for housing have risen by 20% over the past year. Housing construction should follow. Unemployment, though expected to edge up, is still below 6%. Employment has continued to grow, just a little bit more slowly than the labour force. One positive dynamic absent in Japan and Western Europe is our growing population. Australia's immigration, natural birth rate and the return of expats are all boosting our population and household demand. Business confidence remains subdued, but overall the balance sheets are strong. The Australian dollar is Australia's shock absorber and should once again work to support the rebalancing of growth in the economy. As mining investment cools, the exchange rate will likely again play its traditional buffering role. The Australian dollar has fallen over 12% since April this year. This lower exchange rate should help to rebalance production towards the domestic economy. A lower currency improves the competitiveness of Australia's exporters. The relative price shifts encourage greater consumption spending within Australia. Tourism and education sectors will, in particular, get a boost from a lower exchange rate. In observing the Australian economy closely over my 15 years on the Reserve Bank Board, I was reassured by the effectiveness of good policy and a floating exchange rate in supporting our long-term growth. I saw businesses and the workforce responding, though not without pain, to the dynamics of our evolving economy. The Reserve Bank fosters overall stability. The well-being of all Australians is best served by minimising any downturn, not maximising peak growth. Ideally, we want to maintain our trend growth rate. Controlling inflation is integral to sustaining growth, as it avoids the excesses and the requirement for high interest rates to bring inflation down. Steady growth minimises the personal and corporate stress of layoffs. 21 years in the Australian economy without a major downturn is a significant achievement. Future inflation is likely to stay low. This can be challenging for corporate profit growth. Despite the extent of quantitative easing globally, moderate growth, technology, and the ongoing shift in manufacturing to the lower wage structures of the emerging economies are likely to continue to moderate inflation. Australia's banking system is strong, not burdened by the weak assets, as many are. Despite the political rhetoric, our government finances are in good shape. Government net debt to GDP is 11%, a fraction of the 250% in Japan and that of many European countries, which is over 100%. Our recent budget deficit of 1.3% of GDP is a comfortable level, certainly well below the 3% that Europe struggles to keep within. There is a continuing commitment here to fiscal responsibility. With the new government, fiscal constraint could even increase. Global developments will continue to favour Australia as our trading partners are amongst the fastest growing economies. The developed world is probably through the worst of their economic decline. I am constantly hearing success stories. In education, Australia is a competitive provider. Foreign students comprise about 20% of our university students. This is the highest percentage in the OECD. It's about 18% in the UK and 5% in the US. While the high Australian dollar has made us a less competitive provider onshore, our education outside Australia has expanded. There are some 20 universities worldwide who educate more foreign students offshore than onshore. 10 of these are Australian, and I'm very proud to say the University of Wollongong, of which I'm Chancellor, is one of those. Many expressed concern about China's capacity to maintain its growth rate, but it continues to grow at the level which Chinese authorities say they want to achieve. The number of China's middle class are expanding, and Australia will be an ongoing beneficiary of this. Chinese students make up some 60% of our foreign students. In tourism as well, Chinese arrivals has risen 85% in the last 3 years and now comprises 10% of the market. There is a profound complementarity between Australia and China. While China continues to grow its economy and middle class, in addition to our iron ore and coal industries, Australia will be a beneficiary through tourism, education and food exports. Despite the positive relative economic performance of Australia, companies continue to be challenged to improve competitiveness and productivity. Although inflation has been low, electricity prices are rising. Energy efficiency investment is critical to maintaining competitiveness and productivity against an environment of higher electricity prices. Despite sometimes compelling economics, Australia has been a slow adopter of energy efficiency. Energy costs were traditionally low and projects often attracted less management attention than larger equipment purchases. In 2012, I undertook to chair the Clean Energy Finance Corporation, having completed a review of whether such a corporation was appropriate for Australia. The CEFC is a federal government $10 billion specific sector fund set up to invest in renewable energy, energy efficiency and lower emissions. Its board and executive have strong commercial experience in industry and finance. The CFC co-invests with other financial institutions and makes commercial returns. It acts as a catalyst to support and progress emissions reduction projects. The CEFC is outside the budget but funded by federal government borrowings. Its investments to date have achieved a 4 million tonne annual reduction in emissions at a negative cost, that is a positive return of $2.40 per tonne. The mission of the CEFC is to accelerate Australia's transformation towards a more competitive economy in a carbon-constrained world by acting as a catalyst to increase investment in emissions reduction. Our board and executive team are focused on fulfilling this mission while covering our operating costs and the benchmark cost of funds. It is the new government's policy to repeal the Act which established the corporation. Development institutions like the CEFC have generally attracted bipartisan support. Despite the lack of such support in Australia, we have been encouraged by the positive response that our commercial approach has generated, both in the finance and clean energy industries. Until the Act is repealed, the corporation must meet its legal obligations and so continues to invest. The Howard government introduced energy efficiency opportunities, an initiative which required large energy users to identify energy efficiency investments and report them to their boards and the government. Despite payback periods of less than 4 years, the majority of investments were not made. The feedback to CEFC was often that the treasurers played a role in inhibiting these investments. I raise this at this conference in case it can change that situation. As an advocate and financier, the CEFC has been able to progress these energy efficiency investments. Recent higher energy prices has further improved the returns. The CEFC has invested $536 million since July this year. A third of this has been directed to energy efficiency. Investments have been directly with corporations and through co-financing with the major banks and energy retailers. These energy efficiency investments are reducing operating costs and can help buffer a still high Australian dollar. As treasurers, I encourage you to revisit these opportunities. The operating cost reductions can be significant. In doing so, you will be better positioned for a carbon-constrained world. Preparing for the future in a global market is a continuing requirement of business. While governments globally have responded very differently, they are in agreement that the world is becoming more carbon constrained. Australia's preparedness for a carbon constrained world is an important foundation for our future growth. We are hopeful that the energy efficiency investments will continue beyond the CEFC. Prior to any repeal in the CEFC Act, while we continue to invest, the CEFC may be able to assist you in longer-term financing. If steady growth is to be sustained, the combined skills of business and government need to be mobilised. Consistency and open dialogue are integral to securing sound public policy. The Reserve Bank has moved progressively to more openness in communication over the last 15 years. Appointing focused liaison officers in each of the states, releasing the board minutes, and consistently working to improve the public's understanding of their thinking and policy decisions. Similarly, fiscal policy design and effectiveness is enhanced by considered communication and dialogue, less negativity and more continuity, and a smooth transition between governments. The future remains challenging. Consumers and businesses are cautious. There is considerable uncertainty, both domestically and internationally, but Australia is in a sound, enviable position to go forward. We have a track record of adaptability. I remain optimistic that prudent policies and private initiatives will carry us through. Thank you.